Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Broadcom.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we jump in, make sure to check out the VIP Algos link down below in the description.
Yeah, it's an incredibly helpful tool to have in your corner.
Definitely. So right now, Apple possesses this massive $3 trillion valuation, right? Practically infinite resources. And they arguably have the most brilliant hardware engineers on Earth.
Oh, without a doubt. I mean, they are famous for designing their own incredibly powerful computer chips entirely in-house.
Exactly. But there is a specific microscopic piece of silicon inside your iPhone that Apple is virtually incapable of building themselves.
Which is crazy to think about.
It really is. To get it, they've been forced to kind of, bow down and sign a multi-year deal with this quiet giant that operates entirely behind the scenes.
Right, and we are talking about Broadcom, or a $1.78 trillion semiconductor powerhouse.
Yeah, trading under the ticker symbol AVGO. You know, you hear the phrase AI chips, and your mind probably goes straight to NVIDIA.
Oh, for sure. The leather jackets, the massive off-the-shelf graphics processors, that's the main narrative.
But Broadcom operates with a completely different playbook, and they just secured a revenue stream that stretches all the way to the end of the decade.
Because Broadcom functions at a foundational level of infrastructure, one that the broader market often just glosses over in favor of those flashier consumer-facing names.
Right. They aren't just selling individual components, are they?
No, they are architecting the custom nervous systems for the most powerful data centers on the planet.
Which is exactly our mission for today's discussion. We want to unpack Broadcom's true role as the underlying architect of this whole artificial intelligence boom.
And we also need to explore those massive multi-year contracts that just triggered a huge surge in their stock price.
Right. And critically, for anyone managing their own wealth, we need to analyze whether their premium valuation leaves any margin of safety. Because this is a completely ruthless semiconductor market.
It absolutely is. And before we can even understand the financial hype and the recent stock chart movements, you have to understand what Broadcom actually builds.
And why it's so profoundly difficult for anyone else to replicate it.
Exactly. So Broadcom's competitive advantage, their moat, is incredibly deep. And it relies on two primary pillars.
Okay, let's break those down. What's the first one?
The first pillar is custom ASICs, which stands for Application-Specific Integrated Circuits.
Right.
These custom AI accelerators, which Broadcom calls XPUs, currently make up about 60% of their AI segment revenue.
Yeah, 60%. And the other 40%.
The second pillar, driving that remaining 40%, is AI networking. This encompasses the physical infrastructure moving all the data. Things like Ethernet switches, optical components, and scale-out fabrics.
Okay, let's translate that for you listening at home, because application-specific integrated circuits sounds like total textbook jargon. But the concept is actually fascinating.
It really is, once you get past the acronyms.
Think about NVIDIA as a company that sells the ultimate top-of-the-line sports car engine. It is brilliantly engineered, it's incredibly powerful, and you can buy it off the shelf and drop it into almost any high-end chassis.
Right, it's a generalized powerhouse.
Exactly. But Broadcom is a completely different business model. They are a bespoke engineering firm. They build custom Formula One engines that are tuned down to the microscopic level for the exact aerodynamics of one single racing team.
And those racing teams are the massive hyperscalers, right? Your Google, Meta, Amazon.
Exactly. So my question is, once a company like Google partners with Broadcom to build a custom chip, how hard is it to switch vendors? Because, you know, in the tech industry, we constantly hear about companies aggressively swapping suppliers just to save a fraction of a cent.
Yeah. Oh, the switching costs are almost incomprehensible. When a hyperscaler decides to build a custom ASIC with Broadcom, they are not buying a piece of hardware out of a catalog.
Right. Yeah.
They're entering into a multi-year marriage of co-engineering. Broadcom's engineers actually sit down with Google's engineers to design a piece of silicon that is physically hardwired to run Google's specific proprietary software.
Within Google's specific data center layout.
Precisely.
So it's the ultimate ecosystem lock-in. You can swap out a muscle, like an off-the-shelf GPU, but you cannot easily rip out and replace the central nervous system without basically killing the patient.
That is a highly accurate way to visualize it. If Google or Meta wanted to move away from Broadcom after deploying these custom chips, they wouldn't just have to design new hardware from scratch.
You'd have to rewrite their software too, right?
Vast oceans of their own foundational software stack. They would have to physically re-engineer how their servers process and route information. It's a lock-in at the absolute lowest level of the hardware-software divide.
Making Broadcom's position just remarkably sticky.
Unbelievably sticky.
And that stickiness brings us to the second pillar you mentioned, the networking, which makes up 40% of their AI revenue.
Right.
We always hear about the chips themselves, but my understanding is that getting thousands of these chips to actually talk to each other is currently the single biggest physical bottleneck in AI.
It is the defining physics problem of modern artificial intelligence. You can have the fastest processors in the world, but if they are just waiting around for data to arrive, that incredibly expensive computing power is sitting completely idle.
Which is a massive waste of capital.
Exactly. And Broadcom leads the industry in solving this with technologies like SerDes and co-packaged optics.
Okay, let's explain SerDes, because that is a term you will see everywhere in Broadcom's financial documents.
Yeah.
It stands for serializer deserializer.
Right.
So imagine you have 10,000 brilliant scholars locked in a giant room. Those are your AI cores. And they're all generating massive amounts of knowledge simultaneously.
I love this analogy.
Thanks. But they can only share that knowledge with the next room by passing tiny paper notes under a single narrow door.
That is a massive bottleneck.
Exactly. So a SerDes acts as a funnel. It takes all that wide parallel data inside the chip and it serializes it into a single, incredibly dense, lightning-fast lane of traffic to blast across the data center.
And then it deserializes it on the other side.
Right.
And Broadcom essentially builds the most efficient funnels in the world. Combine that with their co-packaged optics, where they replace traditional copper wires, which generate a ton of heat and lose signal over distance, with actual lasers.
Wait, lasers?
Yeah. They transmit data using photons at the speed of light directly from the chip package. They are basically facilitating telepathy between those thousands of scholars.
That is wild.
And here's the crucial point for the business model. This networking gear is required no matter whose chips a data center is using.
Oh, right.
If a hyperscaler buys 100,000 standard NVIDIA GPUs, they still rely on Broadcom's optical components and switches to tie that entire supercomputer together.
So they're completely insulated. I mean, they compete with NVIDIA on the custom chip side, but they profit right alongside them on the networking side.
Exactly. They win either way.
And that immense structural advantage isn't just a theoretical narrative, it just played out in the real world with two of the most powerful tech giants on the planet.
Which is exactly what sent this stock flying recently.
Right. In early July 2026, Apple officially extended its custom chip supply deal with Broadcom all the way out through 2031.
In the technology sector, a 5-year contract is an absolute eternity. Whole product categories are born and die in 5 years.
Yeah, that's a lifetime.
Yet this single contract secures roughly 20% of Broadcom's entire annual revenue. It covers multiple future generations of Apple devices.
And it sits right alongside a massive agreement Broadcom already has in place with Google, right?
Yep. To build custom AI chips and server hardware, also extending through 2031.
Just to understand the sheer scale of that Google deal, consider the AI company Anthropic, which uses Google's infrastructure. They are currently projected to utilize about 3.5 gigawatts of compute power running on these custom chips starting next year.
3.5 gigawatts is a staggering amount of power.
It really is. A gigawatt is roughly the power output of a large nuclear reactor. We are talking about one single company demanding the equivalent of 3.5 nuclear power plants worth of electricity.
Just to run their AI models on custom silicon that Broadcom helped architect, it is almost hard to wrap your head around.
It is. But I want to circle back to the Apple deal, because this is where the moat becomes undeniable. Apple has infinite money. They successfully designed their own M-series computer chips to replace Intel, which was a monumental engineering feat.
Absolutely.
So why couldn't they just build this Broadcom component themselves and keep all the profit?
Because the chips Broadcom supplies to Apple are deeply rooted in analog engineering and radio frequency, or RF.
Okay, how is that different from what Apple already does?
Digital engineering, like building processors like Apple's M series, is incredibly complex, but at the end of the day, it deals in ones and zeros. It is binary. You shrink the transistors, you pack more in, you get more performance.
Right.
Analog and RF engineering is an entirely different discipline. It is dealing with raw physics.
It's catching chaotic radio waves out of thin air.
Exactly that. An RF chip has to take a wildly chaotic, degraded 5G signal bouncing off skyscrapers and trees, filter out all the electromagnetic noise from a bustling city, and translate that into a pristine, high-definition video stream on your phone.
Wow.
And it has to do this while operating inside a tiny enclosed space that is constantly changing temperature, all without draining your battery in 10 minutes.
That sounds like a nightmare to engineer.
It is. It relies heavily on material science and decades of empirical trial and error. It's widely considered a dark art in the semiconductor space.
So Apple pouring billions of dollars into a secret radio lab doesn't just instantly solve the physics problem?
No, it doesn't.
Broadcom's engineering legacy in RF is so entrenched that Apple effectively had to raise a white flag, surrender control of a critical component, and sign a contract through the next decade.
And when a $3 trillion company concedes defeat like that, analysts immediately take notice. It confirms that the technological moat Broadcom has built is nearly insurmountable for the foreseeable future.
And when a company has a moat that deep, it fundamentally alters their unit economics. Which brings us to the financial engine.
All right.
Having Apple and Google locked in is a great story, but we need to see how that translates to the balance sheet. And the scale of growth here is just staggering.
It really is.
In the most recent quarter, just a single 3-month period, Broadcom's AI semiconductor segment generated nearly $11 billion. That is a 143% increase compared to the exact same quarter last year.
That explosive growth means AI infrastructure now accounts for nearly half of the company's total revenue.
Wow.
And their total revenue over the trailing 12 months has crossed the $70 billion mark. But, the top-line revenue is only half the story.
Right, because their pricing power.
Exactly. Because Broadcom provides such highly customized, deeply integrated hardware that their clients physically cannot replace, they wield immense pricing power.
Yet normally building physical hardware is a low-margin grind, but Broadcom is operating with gross margins approaching 70%.
Which is incredible.
Those are margins you typically only see in pure software companies that have zero physical manufacturing costs. They are pulling software profits out of physical silicon. That is the definition of operational leverage.
And the market absolutely rewarded that leverage. The moment the 2031 Apple extension was announced, Broadcom's stock jumped nearly 4% before the market even fully opened.
It instantly added tens of billions of dollars to its total market capitalization.
$64 billion in value overnight.
But here is the perspective you need if you are evaluating this company for your portfolio today. Even with that massive $64 billion leap, the stock price is still sitting about 24% below its 52-week high.
Right, it went through a significant consolidation phase in the months prior.
So the technical setup is showing a stock that had a massive run, cooled off heavily, and is now establishing a solid floor of support around these current levels, backed by guaranteed revenue through 2031.
That's a very interesting setup.
It is. But I have to push back on the extreme optimism surrounding this company for a second. Because CEO Hock Tan has set a long-term target that feels incredibly aggressive.
You're talking about the $100 billion projection.
Yes. He is publicly projecting $100 billion in AI chip sales alone by the year 2027. Now, I'm looking at their upcoming quarterly guidance, and they are forecasting $16 billion in AI semiconductor revenue.
Right.
If you multiply that by 4 to get a full-year run rate, you are at $64 billion. Getting from a $64 billion run rate to $100 billion in basically a year requires a vertical ramp-up.
It's a steep climb.
Is this target genuinely grounded in reality? Or is this just, standard CEO bravado meant to keep institutional investors excited?
Well, it is a vital question because getting to $100 billion requires these custom silicon programs to scale exponentially, not linearly.
Okay, so how do they get there?
Management's underlying assumption is that as the hyperscalers finish the initial design phases of these custom chips, the actual mass manufacturing and deployment phases will kick into overdrive.
Ah, I see.
They expect the custom accelerator portion of their revenue to rapidly expand as Google and others begin filling entirely new data centers exclusively with Broadcom design chips.
This is heavily backloaded.
Yes. It is a mathematically achievable target, but it demands absolutely flawless execution across their entire global supply chain.
Which brings us directly to the risks. In an artificial intelligence market, this highly scrutinized perfection is almost always priced into the stock. We have to analyze the bear case.
Right, what's the downside?
What happens if Broadcom stumbles, even slightly? Because there are some real valuation flags you have to consider here. Broadcom is currently trading at a price-to-earnings ratio near 60.
A PE of 60 means investors are paying a massive premium today for growth they expect to happen tomorrow.
Exactly.
When you command a multiple that high, the market demands that you beat consensus estimates every single quarter, without exception.
And Broadcom didn't do that. Their most recent quarterly revenue of roughly $22.2 billion actually missed Wall Street estimates slightly.
It was a very slight miss, but a miss nonetheless.
And that $16 billion forward guidance we just talked about, that also fell slightly short of what the analyst consensus was projecting. You have a company priced for absolute perfection, and they are delivering slight misses.
Which is definitely a point of concern for some investors.
Furthermore, if you look at the public filings, you see substantial insider selling. Over 1 million shares have been sold by executives inside the company over the last 90 days.
Yeah, that catches a lot of people's attention.
We are looking at dozens of sell transactions compared to only a handful of buys. So let me play the skeptic for a moment. With the PE near 60, slight revenue misses, internal executives liquidating 1 million shares, and fierce competition from companies like Marvell fighting for these networking contracts, is the margin of safety entirely gone?
If you view those metrics in a vacuum, it certainly paints a concerning picture. But context is everything, particularly regarding the insider selling.
Okay, contextualize that for me, because seeing 1 million shares sold sounds like an executive panic dump.
I know it does, but it is actually highly standard compensation realization. Tech executives receive massive portions of their salary in restricted stock units, or RSUs.
Right.
When those units vest, they trigger automatic, pre-scheduled sell programs strictly to cover the massive tax liabilities.
Oh, okay.
What you want to watch out for is cluster-selling executives suddenly dumping shares completely outside of their historical schedules. The data we have on Broadcom does not flag this as a panic. It is just routine tax and compensation management.
Okay, so the executives aren't abandoning ship. But what about that 60 PE valuation, considering they are slightly missing expectations?
You have to weigh that valuation against the broader macroeconomic environment. Yes, a 60 PE is high, but their AI revenues is growing at 143% year over year.
That's true.
When a company's growth rate is literally more than double its price-to-earnings ratio, institutional investors often view that valuation as entirely justified.
Right, the PEG ratio, basically.
Exactly. And the safety net under all of this is the staggering amount of money the hyperscalers are being forced to spend. Current industry projections show that companies like Microsoft, Meta, and Amazon are on track to spend over $650 billion on infrastructure build-outs through the end of 2026.
They are essentially trapped in an arms race. If Meta stops spending billions on infrastructure, they lose ground to Google. If Google stops, they lose to Microsoft.
Precisely. And that forced spending is why major financial institutions like JP Morgan recently upgraded Broadcom to a strong buy, specifically on this recent dip.
Because the backlog of orders is just so huge.
The massive backlog of AI chip orders provides a very clear line of sight into future earnings.
So given that tightrope, a demanding valuation perfectly counterbalanced by massive guaranteed spending from the tech giants, what are the specific upcoming events you need to be watching?
The catalyst calendar is super important here.
Let's map it out, because the next few months are going to make or break the near-term thesis on this stock. What's first?
The primary event is the upcoming quarterly earnings report in late August or early September. The entire financial sector will be laser-focused on any revisions to that $100 billion 2027 revenue target.
So if CEO Hock Tan reiterates that goal with firm data, the market will likely reward the stock.
Yes. But if management walks that number back even slightly due to, say, supply chain issues, you will see that 60 PE ratio compress violently.
But importantly, before Broadcom even steps up to the microphone, we get a direct look into their customers' wallets.
We do. Throughout the summer, we will see the earnings reports from the hyperscalers themselves. We will see exactly what AWS, Meta, and Google are projecting for their forward infrastructure spending.
And that sets the tone for everything.
Exactly. If those companies confirm that the $650 billion capital expenditure wave is on track, Broadcom will likely rally simply on the implication.
And if they signal a slowdown?
If the hyperscalers signal that they are slowing down their server purchases, the entire semiconductor industry is going to take a major hit.
Beyond the hard financial reports, there are also some massive geopolitical and strategic rumors swirling around right now that could act as massive catalysts. Let's talk about the Intel Foundry speculation,
Currently, virtually all of Broadcom's high-end silicon is manufactured in Taiwan.
which carries obvious geopolitical risk.
Right. But there are unconfirmed reports that Apple is heavily pressuring its partners to diversify their supply chains. The rumor is that Broadcom might leverage Intel's new foundries located inside the United States to manufacture some of these custom chips.
Even though high-volume production wouldn't happen for a few years, merely announcing a U.S.-based manufacturing partnership would be viewed by the market as a massive reduction in risk.
It would be a huge positive catalyst.
And there's one more piece of speculation that we have to address. We know Google and Apple are secured through 2031. But imagine the absolute shockwave through the market if Broadcom suddenly steps out and announces a brand new, decade-long custom silicon partnership with a behemoth like Meta or Amazon Web Services.
Oh, it would be staggering.
Because Broadcom is already the undisputed leader in this bespoke design space. If they manage to capture Meta or Amazon for the next 10 years, suddenly that $100 billion revenue target doesn't look like an aggressive CEO projection anymore.
It looks like a mathematical certainty. An announcement of that magnitude would force Wall Street to completely rewrite their valuation models.
And the reason this speculation persists is because these hyperscalers are highly motivated to stop paying NVIDIA's massive premiums for off-the-shelf GPUs.
Absolutely. They desperately want to run their workloads on their own cheaper, custom-designed silicon. And Broadcom is the most capable partner on Earth to help them execute that transition.
Okay, let's pull all these threads together. From everything we have analyzed today, the final verdict on Broadcom earns an 8 out of 10 bullish score.
The fundamentals definitely justify that score. You are looking at a company with 143% growth in its most vital sector, secured by the safety net of decade-long contracts with the most valuable companies on the planet.
And despite the recent pop in price, the stock is currently offering a rare entry point substantially below its previous high. But remember, we are not telling you to buy, sell, or hold this stock.
No, you have to weigh both the upside and the downside for yourself.
Right. The only reason it sits at an 8 out of 10 instead of perfect score is the sheer weight of expectations. That premium valuation means they have to execute perfectly. There is zero room for a supply chain error.
But from a long-term view, it clearly profiles as an indispensable multi-year asset to watch. They are essentially taxing the entire AI revolution, whether the market chooses custom silicon or standard GPUs.
Which leaves us with a final thought for you to take away. While the entire financial world is intensely obsessing over who is building the smartest consumer-facing AI chatbot or who is buying the flashiest off-the-shelf graphics processors, there is a deeper layer to this technological shift.
There always is.
History shows us that as new computing paradigms mature, the initial hype always gives way to a grinding, brutal war over pure efficiency. And efficiency isn't one with generalized hardware.
It's one in the details.
Exactly. As the artificial intelligence market settles into this long game, you have to ask yourself, will the generalized hardware kings ultimately maintain their dominance? Or will the bespoke infrastructure architects like Broadcom, the ones physically hardwiring the nervous systems of these massive data centers, quietly become the most valuable entities in the space?
Because right now, you might like your technology to be visible, neatly categorized, and easy to understand.
But the most enduring power is usually hidden deep within the custom architecture of the machine. Something for you to keep an eye on. And if you found our talks useful, please consider subscribe, like, and comment underneath.
And don't forget to check out the VIP Algos link below in the description to help with your own research.
Thanks for listening, and we'll catch you next time on Smart Wealth with Joshua.